Hello, good morning everyone. I hope you've all had your breakfast or at least a good cup of coffee. If not, you can come to our booth, we got matcha latte, quite nice. So, we all like our coffees in a different way, we like our lattes in a different way. So, what type of roast are we seeing in markets ahead? Here at Schroders, we look at markets as a blend. So we look at the different scenarios that can play out in markets, and then we compare, okay, so what should our base case be for markets ahead? Now, based on the different market developments, we classify them based on hard landing, which is the red color box, if you can see it, soft landing, which is the green boxes, and then no landing, which is the yellow boxes. So the line here shows how global bonds have done since 2023, so the cumulative performance. But here what we're trying to say is, as you see, the boxes are all different color, and there will never be one dominant narrative in markets. So market narrative will always be swinging around, will always be changing very aggressively, which is why here we look at markets in a three-dimensional lens. So based on the three different scenarios, we sort of look find our view of the world. So hard landing, which is the red color box, means a recession. No landing, stagflation. And then soft landing, which is our base case, and it means that we think growth will be slowing down in the US, not collapsing, just slowing down. The Fed will be able to cut rates, but gradually back to their terminal rate level. So as you see, our base case is for soft landing, but we also recognize there are a lot of moving parts in markets. I mean, we have Trump, he's pretty erratic in his policies. We have tariffs, we have geopolitical tensions, we also have the fiscal bill that's been going around. Anything can happen, which is why we recognize that there's an even balance of risk also between no landing and a hard landing in markets as well. So these are some of the different factors we look at when we classify, okay, what should our base case be in markets? And as you can see, most of the factors that are currently playing out in markets is actually pointing towards a soft landing going forward as well. So I mean, we all know that the year started out not very well for the US, pretty turbulent. We first started off, with all the narrative about US exceptionalism, and then its very own president, President Trump, sort of shackled the economy's potential with his so-called Liberation Day tariffs. And then come de-dollarization. All this has been bubbling around everywhere. We see sentiments have been very bearish among households, among businesses, even investors. Many were very focused on US assets, but now they're thinking, oh, this is like an awakening moment. I need to diversify. It's time to move out of the US into other parts of the market. Of course, we recognize that this is not going to happen very fast. The concentration in US is very big. It will take time to slowly play out, but the awakening moment is there. So, I mean, the good thing is, of course, the labor market in the US is at least doing okay. So it's pretty supportive for the consumers. We saw the June NFP print that came out just on Thursday, quite positive, larger than expected. So at least the labor market is stable. I think we saw a lot of negative narratives around the US, but yeah, we see doesn't look like anything's happening. We see growth based on the Federal Reserve of Atlanta, based on their estimates. Q2 GDP growth estimated to be 2.6%. Looks quite impressive. It looks like all these headwinds is not really affecting the US. So what's actually happening? What's happening here is the US consumer. The mighty US consumer, don't underestimate them. They make up 2/3 of GDP growth in the US. And US consumers have been supported by supportive fiscal policy, but that's not all. There's also the wealth effect. Wealth effect meaning, if you look at US equities, you look at US real estate, they're both actually doing quite well. And the US consumer has pretty big stakes in both US equities and US real estate, which is why you see that in terms of income, their income potential is actually quite good. So from an income perspective, they are doing fine. Their spending-wise, it's not really matching up to the amount that they are growing, but it also means that they have good buffer should price increase in the future as well. And then for labor market, as we know, it's stable, but we also see signs of it cooling, not crashing, just gradually slowing down. We see the initial jobless claims, it's going up a little bit, but layoffs are not really going up, which is a good thing. And then we also see in the recent payroll reports that it is government employment that sort of surprised to the upside. But when we look at private payrolls, okay, they are gradually slowing already. So it's a good direction to be headed towards, and we think this will also continue because immigration is slowing, and we also have aging demographics in the US, which means that going forward, the labor market net, it's doing fine, gradually slowing down, just will not be crashing. And then inflation. Inflation is a bit interesting. We see a lot of mixed views in the markets about where inflation will be headed, thanks to the tariffs. Okay, maybe the tariff impact won't be so big on inflation. They're not wrong. We've seen the inflation pass-through from tariffs hasn't been that much, actually, even though tariff revenue has been going up in the US. And then there's also the other camp that think, oh, inflation is going to be spiking. We need to be a bit careful. But let's take a step back first and see where are we standing in terms of inflation. So if we look at this chart on the left, you see that inflation was the highest in 2022, and we've been making progress. Slowly, this inflation has been coming down. Shelter was very sticky, refused to budge, but now it's gradually coming down as well, which is good. So, and then we also have inflation expectations. This is pretty important for the Fed. One of the key mandates for the Fed is, of course, inflation. So inflation expectations, we also see it's been moderating down thanks to all the trade talks. Not so bad anymore. Doesn't sound so bad. So inflation expectations have been moderating down, and the Fed will be watching this like a hawk now. So then, of course, we know the biggest upside risk to inflation will come from tariffs. No questions there. And what will the impact be from tariffs? If you look at the breakdown of the different countries, it feels that the biggest sort of impact will come from China. So the amount of tariffs that will be levied on China will probably make quite a big dent on inflation. For now, we see, okay, US-China relations look pretty cordial, right? But what's to say this won't go south anytime soon? No one knows. I'm sure even President Trump doesn't know himself. So what we are saying is, you can either brush off the inflation impact from tariffs, or it might keep you awake at night. It's basically saying it's quite uncertain at this point. But what we know, no matter what the impact is from tariffs, it will probably be lagged. So businesses will slowly absorb the costs, and when it gets excessive, then it will slowly filter down to consumers. And also, that may take time. It will lag. It can go anywhere from 1 day to up to 12 months. Even the percentage that gets passed through to consumers will also be different. Service firms, for example, will probably be able to pass a bit more down to consumers. So this will also differ. So everything is sort of uncertain in that sense, but if consumers do feel the impact from tariffs, we know it will be lagged, and so the effect on inflation will also be lagged. Everything is uncertain. We all are waiting for the July 9 tariff deadline, where things will be going. So we see growth still doing okay, labor market still doing okay. So makes sense that the Fed is on hold. They are probably not going to be doing anything much for now, even though Trump keeps making jabs at Powell for just sitting idly. But his hands are tied. Trump is the one that brought in tariffs and then changed his mind about it, and then he brought in inflation uncertainty. Otherwise, I'm pretty sure Powell will be well on his way to cutting rates to reduce interest expense in the US. So coming to that, fiscal deficits in the US, I think this is what we've all heard about so much, and we can even see on the chart on the left. So that's the red line, which is showing the federal government debt. It's nicely going up, steadily increasing, which means the US administration is just happily spending without a care in the world. We've also known about the passage of the recent bill, the One Big Beautiful Bill. Supposedly, yeah, there are some spending cuts in there, but the main point of it is it actually increases fiscal deficit by about $3.4 trillion over the next 9 years. Yeah, maybe if you say, okay, the tariff revenue can sort of offset it a bit, but the point is not to offset. The point is you need to reduce the debt. Debt levels in US is already at very unsustainable levels. And if you remember, the US also has a current account deficit, which they are miraculously trying to plug using tariffs. So who are funding all these deficits? You have current account deficit, you have budget deficit. Us, foreigners. So the foreign inflows into US capital markets are what is financing these deficits. We hear all this de-dollarization narrative that's been going around, which means that now foreigners, okay, maybe they won't increase their allocation, they won't decrease their allocation, but they are not going to be increasing their allocation to the US. So there's going to be some issues with funding going forward for the US as well. So this is something to watch out for. And then, I mean, if US markets are in a mess, there's no reason why their rates market need to move in an orderly manner. So we see the 5-year segment of the curve, okay, still aligned with the Fed, not too bad, but the 30-year segment is just in its own world, just has been nicely steepening ever since Trump got elected. And which is why I think everyone already knew that once he got elected, likely there'll be tax cuts, there'll be increase in spending, more deficits means you need to issue more. So there'll be more supply in the 30-year part of the curve, which means it's not really a good part for investors to be in. So with all this de-dollarization narrative, the part that's been benefiting actually is Europe. Europe has been a good alternative for investors that are interested in DM exposure. I think if we recall for the past 20 or so years, the US exceptionalism narrative has been dominating markets. People are not very keen in Europe for a few reasons. The politics there were a bit messy. We had some civil wars, things not very stable, and then yields were negative in Europe. So yeah, it makes sense why people wouldn't be that interested in Europe. But tides are turning. We see yields obviously not negative anymore. It's quite positive. We also see that growth, okay, maybe not flourishing, but it's actually improving. Activity has been picking up. We see loan demand has also been inching up, which means that we are actually headed in the right direction already. And I think what caught people's attention towards Europe is also the fiscal stimulus that we've all heard from Germany. European authorities have been actually very hesitant to sort of, use any fiscal stimulus for a very long time. So this sort of took investors by surprise, took markets by surprise, not a bad thing. So we do think that the fiscal stimulus going forward will be positive for European growth in the medium term, which is also sort of reflected in why the curve in Europe is steepening. But unlike the US, it's not because of debt sustainability concerns. It's actually positive because you think economic growth prospects are looking better in Europe. And then inflation in Europe, yeah, it's coming down. It's not undershooting. Inflation is the ECB's only key mandate, and with growth doing, well, sort of okay, inflation's doing okay, we think there's no reason for the ECB to continue cutting, which means they are sort of almost done with their cutting cycle already. And with that, if we look at duration, where do we think we should be allocating to? First, the US. I think we all know that there's definitely some scope for the Fed to be cutting rates. But it's very volatile, so we need to be quite careful in terms of our duration exposures in the US. And then Europe, I think we all know, at max, maybe just one more cut left, which means, yeah, that's already quite priced into markets, so there's not much juice for us to capture in terms of rally. What stands out is actually the orange bar, which is UK. You see it's pretty high for a DM market, which means that markets have not fully priced in the cuts for the BOE. So there is still some scope there for us to sort of catch the rally. So a good sort of cross trade would be long UK duration and then use Europe as the short leg. But overall, we just also need to be careful when we are managing duration because we have seen a change in market regime. We are no longer in the zero interest rate environment, which means duration can literally make or break a fixed income fund's performance. So you have to be very calibrated and very nimble when you're making duration exposures in a fund. In terms of credit, I think the numbers speak for themselves. You can see the height of the bar. They also sort of speak for themselves. Here you see in every time period, European credits on a dollar hedge basis outperform US credits. Even Sharpe ratio, especially for European IG, is way higher than US IG, which means your risk-adjusted returns that you're getting there is a lot better. So what we're saying here, let's not be sticking to just one asset class just because it's familiar. We need to be a bit more nimble and look at where there are better prospects, especially if you're not actually giving up much in terms of risk, but getting better rewarded. So with that, this is our base case. Our base case is for soft landing, for the world to be achieving a soft landing, and a sort of even balance of risk between hard landing, which is a recession, and no landing, which is stagflation. So based on the different scenarios, we sort of try and forecast what could credit markets look like in the next 12 months. So our base case is for soft landing, which is the first column. We think, okay, the Fed can cut, maybe just need to do one cut because the economy is not in a dire state, it's just slowing down, which is fine. And then spreads, very tight already. So there's not too much that can tighten from here, maybe just a little bit more. But if you look at the last line, which is, no, not okay, last line, the returns, you see actually a bulk of it is coming from starting yield across all scenarios, which means even if markets don't do anything, nothing happens, we also don't do anything. We see that the starting yield itself is enough to carry us through over the next 12 months. So it's a very good point to be for income investors. So what's the perfect blend then? If you see credit markets, no one asset class will always be able to dominate every year. So you have to be a bit more nimble and agile. And which is why also portfolios cannot be very static. We have to make sure that we are being agile when we are making allocations. We are being agile making allocations and also responding to evolving market dynamics very quickly as well. Cannot just stay static. And of course, if you look at valuations, if you see credit markets, okay, very tight. Almost every segment are in the red zone, which is historically expensive. And that means that everything is quite expensive to buy. So what do we do? I mean, we are credit investors. We can't just keep everything in cash and just sit down. And we don't need to do that. The credit universe is very big. The whole global credit universe is spanning across US, Europe, EM, Asia, even alternative credits, securitized, which means that as long as you are being selective and you are investing without any biases, you can always find opportunity somewhere, somehow in credit markets, which is why our Schroders ISF Global Credit Income Fund has the winning formula. It's worldwide, meaning one fund, many opportunities. Doesn't matter which part of the credit market it is, so long as we find value, we will enter, we will allocate. It is income focused. It means that it provides a stable, reliable payout of 6.5% for the dollar share class in an average IG credit portfolio. Pretty attractive given all the volatility in markets. And it's nimble, meaning that it's unconstrained, it's very fast, can make changes very fast without having to think about benchmark. So pretty useful, especially how volatile markets are in this space. So are you here to win with GCI?